Welcome to On the Edge, a show examining how deals actually happen in commercial real estate. Host Malcolm Davies, founder of Way Capital, speaks with professionals in development, investment, finance, and more for insights into how these business leaders get deals capitalized. Malcolm's career spans more than 20 years, during which time he has managed nearly $20 billion worth of financings. Now to your host, Malcolm.
Hey everyone, welcome to the next edition of On the Edge from Way Capital. I am super excited today to have a great friend of mine, Dennis Allen from Wolverton Capital, join. Dennis, welcome to On the Edge.
Hey Malcolm.
All right, where the heck in the world are you right now?
I am at my home office in Portland, Oregon, where I reside. So hence the ceiling fan in the background and, the bed and the look at the New York picture back there. So that is a relic of before they, when Zoom first started happening and during COVID and you were doing these all the time, I was like, I got to put something on the wall back there to make it a little bit better. So I went out and got this big picture in New York to, stick with the urban theme and the real estate theme. So it still remains today.
I love it. So are you doing lots of deals in New York?
No, none. and then it's funny. I had people like when I first had it up that were New Yorkers that would be like, we start figuring out where it's at. Like, oh, I know that building. Like that's the corner of whatever. I'm like, I don't know. That's just a bunch of pictures in New York.
It's somewhere in Midtown off of Lexington, I think. So we'll see.
Congrats to you on being a first mover in the podcast game too.
I don't know if I'm first mover, but I'm definitely jumping the bandwagon. And what's the theory? They say it used to be important for guys like me to know everyone in the world. Now it's probably more important that everyone just knows me. So there was a theory around it. But really the theory behind all of this is to get great groups like Wolverton exposure to really not only to educate, but also to really help establish groups that I think do sometimes sit beneath the radar of the larger, quote unquote, large scale institutional world of commercial real estate investing, somewhere between obviously syndications and, institutions. And so I think Wolverton fits right in that dynamic and the things that you guys do. On that note, I think before we get into the Wolverton world, Dennis, maybe tell the audience a little bit about your personal background. How did you get to be in commercial real estate? And frankly, how did you get into being, an LP capital provider in the commercial real estate world today?
Yeah, well, I grew up in LA and went to school at USC. And then when I graduated, I got into the real estate development world. So that, where you and I kind of met each other was I was a developer in Los Angeles for a number of years with a couple of big development companies there. And then I moved to Portland about 12 years ago now to work on a big 30-acre site that a family owned on the riverfront in downtown Portland. So fantastic piece of property that we were going to develop into the next great sort of mixed-use, vibrant district in Portland. And then Portland passed an inclusionary zoning policy or a set of policies, rent control and inclusionary zoning, that made it extremely difficult to develop at least commercial multifamily buildings, which is what, I did mostly, made it really challenging. So that project sort of fizzled and I found myself as a developer in a city where you really couldn't develop anymore. It didn't really make sense. But the family had built a nice life here. We liked living here. I didn't want to move. I considered being a developer, a remote developer in other cities or places, but that's hard. You really kind of got to be there and, proverbial know everybody and all that stuff. And so the other idea I came up with was really starting Wolverton. And Wolverton was sort of founded out of, I've always been an entrepreneur. So I've always had, several different businesses and started businesses since I was young. And the best businesses solve a problem. That's what they'll kind of say. And so Wolverton was really the solution to two problems that I saw. I had my partners are high net worth family office in Los Angeles that I've known for a long time. I was helping them look at deals and they were even looking to invest with me in my real estate deals. And I realized that many high net worth investors and family offices don't get good deal flow. They're not diversifying how they're investing. They're not being very specific about the markets they choose when they do get them. They're not diligencing properly. They do a deal because a buddy sends them a deal. And that's how a lot of it gets done. And there's nothing wrong with that, but I think they realize that should be a more prescriptive way of investing in real estate. And the other problem I saw was that there were really good developers, many of whom I was friends with around the country in what I'll call second tier cities or non-coastal markets who were great cities. They were all having some kind of resurgence, in their jobs, redoing their job bases, having their cool downtowns, happen again. And they were having trouble finding capital because the, traditional capital sources didn't want to be in some of these second tier cities. And they were also, by the way, getting really good return on cost spreads. They were building to higher return on costs. They could get the same, Fannie Freddie agency financing. So you had a margin of safety built in. So I saw there was an opportunity where and they couldn't raise this kind of middle market or tweener equity. I know middle market is thrown around quite a bit, but to me, what that meant was more than you could raise on your own as a developer by just passing the hat, and small enough, though, that you weren't getting interest from the larger institutional shops. So at the time for us, that was kind of the $8 to $12 million kind of equity space. So that was the marrying of the two problems, giving high net worth investors a way to invest more systematically around the country in good deals that I could help them diligence as a developer, and finding these developers that were doing good deals in these really great second tier cities that were happening in the United States. So that was 7 years ago. We've done 10 deals to date in places like Minneapolis, Pittsburgh, Salt Lake City, Denver, Columbus, and Houston, and keep looking at these kind of non-coastal second, or, we have a deal in Bozeman, which is a third tier, it's really like a third tier tertiary city, but places like this that are having good population rent growth and are cool places to live.
You've heard me say this before, but if it's a secondary market, I always call it emerging primary. If it's a tertiary market, it's emerging secondary.
Right.
So part of your thesis really is focusing on multifamily development. And forgive me if I'm wrong in this, but please confirm for the audience. You are investing in ground up development for multifamily in secondary markets, generally not on the coast, it sounds like. And let's make sure we kind of fill the audience in. So how did you determine the secondary market strategy? And then obviously your background in multi is probably the reason why you stuck with multi, but maybe the reasons for, multi itself and in these secondary markets.
Yeah, let's do multi itself first. So I've developed most kinds of real estate over my career. And I just happen to think, like many people, multifamily provides the best risk-adjusted return. Certainly you can make a higher return in other product types, but you're taking on more risk to do so because you're reliant upon one tenant or a few in office or industrial or, retail or all that type of thing. So for all the reasons I think your listeners all know, multifamily is the best risk-adjusted returns. Then we do multifamily development really only because really my background in development allows us to minimize execution risk as much as we can. So we are like kind of taking out as much as execution risk, and that scares off a lot of other investors. So there's less competition there for us when we're coming into that space. We just find that we're able to find really good developers in these cities and really have not as much competition as if we were trying to invest in like value add real estate, where there's a lot of people that are in that space because they don't want to play in the development world. And we're very comfortable in that world, sort of given my background and where we're at. So that's why we do multifamily development.
In those markets, as we know, right, generally those markets have developers that know the market very well. They can identify great sites. They know the municipalities. They know the jurisdictions. They know how to get projects approved. A lot of the institutions they fly over them, right? There's no question we have a flyover element in the United States, but these places do have job growth and they have population growth. So, generally speaking, how have you identified those markets? And then we'll get into kind of the sponsors themselves, but just those markets and said, hey, there's a reason why we like this one, XYZ.
Yeah. So we do this process every year at the start of the year to pick our kind of top, 20-ish markets for the year. We take data sources, from different, CoStar mainly, but, all the different data providers, put them into a spreadsheet and filter them for things. A lot of it's obvious stuff: job growth, population growth, we're growing. Then we factor in supply. So, a place can be good and growing, but it doesn't want to get overbuilt. So we factor in supply. And then we put some qualitative things in there, like, how good are they to live? Quality of life metrics as well. So we put all of these into a spreadsheet, filter them down. Out of the bottom of that drops, like around the 20 or so that we want to work on because we don't want to be in every market all the time. And then we go there. If we haven't been there, we go there and we check them out and we say, yeah, this is the type of place that people want to live. We can see the things that are happening. The data doesn't just say this. We can go there and see that, yes, they've got sporting events that are happening. They've got cool bars and restaurants. They've got all the things that people want. They've got, great schools and quality of life, and the airport accesses lots of different places, all the different stuff that you would want to see, kind of a major city have and be sort of a livable environment. But it all starts with jobs and population growth. And then after that, we kind of determine why we want to be there.
In those markets, you're looking at identifying, sites and sponsors. What has been generally the approach you've taken, to work with a developer, and how, when you've done these 10 deals, how ingrained is Wolverton in the development process itself? At what point do you come in to these projects?
Yeah, so to pick the developers is once we decide we like a city, then the hard work begins. And, when we started 7 years ago, we really, I knew some people just from my ULI network over the years and just getting to know developers, but you got to learn the developers in the market. So it's a lot of hard work. It's going there, it's setting up meetings, it's getting introductions, it's cold calling, it's cold emailing, it's all of the above to get to know the developers. And then you do calls with them, introduction calls, and, you can get to know through calls and visiting and seeing them, and then what they're like, and if you can do business with them, and if you're going to have a good relationship with them, and then also their track record, and can they prove themselves, have they done it, that type of thing. Then once you get to know the developer, then they sort of start sending you the deals, and then it's our job to determine if what the developer is saying we agree with. So they say, okay, this is the cool part of town to be in. This is the up and coming spot. And we don't try to do a lot of that. It's more about picking the developer. The good ones are going to know those spots. We're just sort of verifying that. The analogy I use in our business is a little bit like a fishing analogy, which is we can use data to determine which lakes around the country all the fish are being pulled out of because they're, sort of showing the data and numbers. So, okay, I want to be in that lake because fish are being pulled out. But we don't know which corner of the lake the fish are happening from or which lure to use or all that kind of stuff. That's the fisherman that knows that, right? The same equivalent with the developers. The good ones know where stuff is happening. They know how to shake land loose from land sellers. They know how to get involved with all the different people to get the tax abatements and all of that. They show that package to us, and we just determine, do we agree with them?
And then how early do you get involved in the projects themselves? Do the developers generally, have they bought property in the land already? They've paid for the construction drawings and the entitlements and the like? Or do you come in really once the project is shovel ready? How do you determine that?
Well, we close and fund when the project starts the vertical construction. So we're usually closing coterminous with a construction lender. So we go vertical. Yep. We get involved earlier than that. It just depends on the developer. What we don't do is we don't assist the developer with any of the pre-development costs or any of that. We'll reimburse them for those above and beyond their equity co-invest amount at closing, but we don't participate beforehand. But sometimes developers show us stuff when it's shovel ready, where we're looking for equity, it's time to go. And sometimes we know them and they're talking to us about just land they've got their eye on. And so we start talking about the deal when they're sort of looking at the land. But in all cases, they are either taking the land down or at least procuring a sales contract that allows them to close when we start construction.
So when we hear the numbers we're talking about, I think for just the audience, when you think about this, there really is a void in the capital markets for what Dennis's company does, which is to provide, middle market can be very different for many people. But if you just said from 8 to 12 or $15 million from an LP perspective, that means an XYZ amount size of a project. That is a real challenge sometimes because there just isn't as much available capital. So Dennis, can you give the audience a bit about what does that typically involve on a number of units per project? And conversely, when you see these projects, are there larger projects you've ever got involved in? And then what's the smallest? Kind of give us the scale that folks can think about.
Yeah, it really depends on construction type, as you know. So, podium or, obviously we don't do high rise, but the denser the product, the more expensive it is. And so therefore the money goes, doesn't go as far on the unit. So we've done deals as low as 70. We have a 78 unit deal. And we've done deals as high as 255, units. Mm-hmm. And normally, though, our equity check, and it really equates to a $40 to $60 million total project cost. That's usually in the 100 to 200 unit range Again, it just depends on construction type. We also part of all of this stuff is very purposeful. We're in that equity check size range, number one, because that's how we can allocate our investors' money, across multiple deals. So they're being diversified. But it's also, as we talked about, it's less competitive. There's less people in that space. And then we also like that unit size range of that kind of 100 to 200 units, because you're not releasing, the really big deals you're releasing upon yourself after it takes longer than a year to lease it up. So you're fighting through like renewals and stuff as it's coming. So 100 to 200 unit deals is usually our sweet spot. Lease them up in a year and then hopefully, put them on the market and sell it after that, or keep it long term if that's what the partnership wants to do.
Well, let's stay on that for a moment. I think the yield on cost and how you're evaluating yield on cost in these particular markets and what that spread is to the exit cap rate and the like. But you mentioned something that is sometimes music to the ears of developers, because every developer generally knows that they're going to build, stabilize, and sell. It's generally the business plan, but not build, lease, and keep. Is that something that's discussed with some type of a crystallization structure in advance, or how does that work for a developer to think about Wolverton, from either keep it from a long-term perspective, or generally, I'm assuming you're going to want to build, lease, sell as the primary strategy. Can you talk about that?
Yeah, the build, lease, sell, that's the primary business strategy, the plan. That's what most developers want to do. Our investors are fine with that. We're fine with that. But I've always been a big proponent in my career of don't try to pre-time things. Let the real estate tell you what to do. Get it built, get it stabilized. That's the hard part. And then look around and see what the capital markets look like. If they don't look good, then hold on to it. And so and wait for the better day and whatever that is. Or you might really determine that it's a great asset and a great city and you want to keep it long term. So we have a mechanism that we've built into our JV agreement whereby we, Wolverton, have the right to hold it long term if we want to. And the way that works is we have the developer go out and get appraisals or BOVs. We have them go out and get refinance proceeds. And then if there's enough, and then we come up with fair market valuation, and then we sort of run the waterfall, if you will, on the deal. If there's enough money to pay the developer their promoted interest, which they've earned at that point in time, and to pay any investors who want to leave or exit the deal and everybody else wants to stay in and hold it, then we'll hold it long term. If there's not enough proceeds to do that, then the default would be just to sell it at that time. So that's kind of the mechanism we use. So the developer doesn't get stuck. They get their promote when they earn it. If it gets crystallized and rolled in to cover some other investors or different ways like that, then we have ways to figure that out. And of course, their equity goes in alongside of us, their co-invest. We treat exactly like our money. So they can also just keep that money in the deal and take their promote out at that time if they want to do that as well.
That's actually a very great, cool structure for many developers. Let's talk about how that kind of plays out from what a yield on cost needs to look like to be attracted to Wolverton, and then generally how your waterfall and promote structure are put together. How does that generally come together in the way that you're reviewing it? What are you looking to get to from an IRR perspective and the like?
So return on cost is really just a high level metric to kind of tell if you like the deal. As most people that have done real estate know that. I mean, there's a lot of things that can change and make a return on cost good or bad, the initial. But the development world has always had that spread, 125 to 150 basis point spread off of exit cap as a rough metric to show general profitability on the deal and if it generally works as a development project. So, everybody says, what's your return on cost you're looking for these days? I said, well, I don't know. You tell me what the exit caps are these days. And everybody's kind of trying to figure that out, right? But, whatever. If they're back to 5 exit caps now, which it seems it's hard to pencil anything less than that in, then you're kind of at, that's why I think you're hearing everybody in the industry at that kind of 6.5-ish range for return on cost. We're the same, right? And maybe if it's a tertiary market or something and the cap rate's a little higher, then the return on cost has to be a little higher. But the reality is where, IRR is what matters and times money. You have to balance the two of them. Our deals all to date have been a IRR-based promoted waterfall structure. So the better the deal gets, the more percentage the developer gets over a couple of different IRR hurdles.
Yep.
And just strictly IRR-based. So therefore the developer, there's problems with IRR only, but in development, you can't really game IRR too much because you got to build the building and you got to stabilize it. So you can't do that like in a value add deal. You can't just flip it right away. So IRR pretty well, and it gives a timing incentive to the developer to get done quickly and get things moving. So that's why we've done it today.
Is it generally a 90-10, 95-5? Okay. And then certain IRR hurdles, you have a pref and then kind of a 2-tier or 3-tier waterfall after certain IRR hurdles that the promoted interest for the developer grows at that point, just standards and stuff like that.
Right. We do two tiers. I don't like the 3 and 4 different tiers ones, right? But it's always like if the deal does, when I was in the development world, I always got frustrated where if it really crushed it, then the developer sort of gets the same as the equity, especially when equity always wants like preferred returns in their base, really wants a bunch of double. So even to this day, even now that I'm equity, I still think the case is better where you make the returns, the splits to the developer go higher on the top end. So if they really crush it on something, they get, a better return on that or a better split of the percentage of the profits as it does a lot better.
How about fees? I mean, what's a developer's thought process here working with Wolverton and the fees that
we don't charge any, our fees are all internal to Wolverton, right, and our investors. So we don't charge the developer anything. And we also are, the developer can charge typical market rate fees that they charge. So we'll let a developer have a developer fee, obviously, and let that be kind of within range of what market is our developer fee. We don't normally allow for a bunch of excess fees. So we don't usually have a lot of acquisition fees, disposition fees, financing fees, et cetera. I get it. If you have to have a guarantor or want a guarantor fee for the construction loan, that seems appropriate. We usually won't do asset management fees because, again, you're usually trying to sell it at stabilization. So a developer fee that's, certainly gets them everybody paid on the project, but isn't where they're making all their money is totally fine with us.
The perspective of Wolverton and debt, we've been in a tricky debt environment for a number of years now, which means that if we're doing a bank deal, the leverage is relatively low. If you do a debt fund deal, you get more leverage, but then that's more risk. How do you think about debt as it relates to your investment thesis?
We've always been a little bit more lower leverage and risk averse, I shall say.
Yeah.
Trying to do just a typical construction lender and not going over 65 or 70%, total loan to cost. That's being limited for us by all the banks these days. They're not even getting to that, but We've resisted to date pref, equity, mezzanine, sort of taking it up higher in the capital stack. As you know, leverage is your friend and foe, and those can look great when you're in the underwriting. But if things go wrong, and they do in development, you can pay a steep price for having those extra players in the process, as well as the debt. And even with the debt funds, they're great. And we've had debt funds on deals, and they were really great lenders to deal with. The problem is the interest rate is higher. Yep. And if your deal goes beyond its projected, initial development period, and that loan is fully drawn and you're paying that, S6 or 700 rate, it can really eat into your cash flows or eliminate them real quickly. So you just have to be real careful.
So cost overruns, always an issue in development.
What cost overruns? Those don't happen.
Does it? So how is it treated in the structure with developers that do business with Wolverton?
So we, being a developer, I'm sympathetic to how hard it is, but I'm also have done it a lot. And so I point out to them, you should know these things. So what we do is we do 2 concepts in our JV agreement. We do one that's called controllable and uncontrollable cost overruns. So there's a bucket of uncontrollable. That's something that you, developer, can't control, right? So interest rate increases and stuff you find in the ground and force majeure and all this kind of stuff. And we really work in the JV agreement to define that bucket, and everything goes in that bucket. We participate per pursuit in the cost overruns with you. The second thing, then anything else is a sponsor cost overrun. Anything in that category, the developer has to pay out of their own pocket. We also do something pretty unique that I don't think I've seen done before, which is there's always contingency on a deal. So then the question becomes, well, who gets the use of the contingency? And it seems unfair if something happens in the very beginning that's either sponsor or, we call it owner cost overrun that we participate in. If you use all of the contingency up, and then the next things that happen to be the other side's, cost, and it's already been used on the other thing, that seems very unfair. So we've come up with this way to actually, for all budget overages. So we don't, we have like a limit on where we approve change orders and budget changes and stuff. We have to come to us, but every cost increase or budget change we're tracking, and we put it in a category in the contingency usage so that we're like tracking who's using it. So let's say that at the end of the contingency being gone, let's say it was $1 million, we, the owner, have used 60% of it on, owner things or things that were in the uncontrollable bucket, and the sponsor was only 40. The next dollar that's a true cost overrun, we fund it based upon that percentage because that's who used the contingency, and that only seems fair. And so we've just kind of come up with that over the years because when you start dealing with this a bunch and you're working with people you like, you always we want to be really fair and honest in how we deal with things at Wolverton. And that was the best way that we could come up with to be fair about how the contingency is used before it becomes a cost overrun.
This is actually a good transition to the next question, which is, how is it to work with you, Dennis? What should someone expect? I mean, obviously we know this business is a courting process. That's, I always tell like people what I do for a living is like Match.com. But, the reality is, what is it like once you've broken ground, the venture's closed? Are you part of all the OAC meetings? Like, are you how involved is Dennis and Wolverton in general, just in the process of development? And, I've always said this, don't ever do a deal unless you really enjoy talking to the other person. It makes no sense. It's not that two people are bad. They just don't get along. They're just not the same person. So, but how is it to do business with you in that regard? And just kind of figuring out like, hey, I can call Dennis about this, and this, and what's it like for you?
Yeah, you totally nailed it. This is why we do so much work in the beginning to realize if we really like our partners, because you want to do business with people you like, you're going to be talking to them all the time. And so we've been lucky. All of our development partners are great people, and we've become close friends with many of them, and they're really, really good to deal with. But the answer is, how often do you deal with Wolverton? We try to do all of our work up front. We have a pretty detailed diligence process that I think the developers, when they first look at it, probably go, wow. And then they'll probably all admit to you that it made them better all the way through it. But when we get done and then we're closed and under construction, our process, so long as nothing is going wrong, is we talk once a month. They send a report over. We get on a Zoom call like this. We talk once a month. Yeah. We come out quarterly to view the site and just sort of hang out and, go get dinner and, see the contractor, just make sure everything's going okay. And that's really it. We're not in OAC meetings. We're not like in the details and all the stuff. We're not staffed that way. We don't want to be that way. We want to have investors that we sort of can trust and have a process in place that they're doing that. That said, if things go wrong, then we've got to get involved and come in and sort of make sure that we get, the ship righted until we can get the budget back on track or the schedule back on track or whatever. But I think most of our development, all of them, I think if you talk to them, would say we've been great to work with. Because we've been in development, we get it. When a developer calls me with a problem, I joke, you don't yell at them and go, what do you mean you have a problem? It's more like, of course you have a problem. That's all real estate development is a constant dealing with problems, right? So It's like, all right, what's the problem today? What's your proposal for how we deal with it? So long as they've thought through it and we come up together like what it is, we'll get through it, And so I think most of our partners enjoy working with us.
Yeah, I think development is one of those things where it's not what's going to go wrong. It's when it will go wrong and how you handle it. Okay, getting closer to the end here, and I just want to talk about where the market has been and where we're going. Now, I think we all recognize that we've been in a hyper inflationary cost environment for some time. It seems to be subsiding a bit, which has been beneficial. But that doesn't mean that costs aren't going up other areas, right? So insurance costs are going up on operating expenses. And so we're getting pressure in that regard. And interest rates, which, we're coming down a slight, have ticked back up a bit on long-term rates, all of which leads me to kind of ask every one of the guests that comes on the edge, which is, how do you see the next few years as an investor in commercial real estate multifamily? What are your thoughts and prognostications about, your activity level, in 25 and 26?
Well, you nailed it. It's really hard right now. That's just why there's hardly any development happening. It's like, we had all the supply that happened when the money was sort of free, but now that it is, cap rates have gone up and therefore yields have been squeezed. And you're totally right on the operating expense side, insurance, the payroll, everything. We've gone up a lot in all the areas. So it makes the development yields really hard to get. We're lucky that we're not trying to do 10 deals a year. We're just trying to do a couple. So we can really look for the proverbial needle in the haystack that's got really good land basis or a tax abatement or, something about the deal that makes the numbers work, but they're really hard to find. And we hope to keep doing that. I have never been a market timer. I'm not I just don't think, it really can be done successfully more than sort of once in somebody's career. It's kind of so try not to time markets. We instead say, just build. You build in markets that there's going to be job and population growth. So don't be reckless in your assumptions. Make sure you have good assumptions in place, that you have some downside built in. But keep building multifamily because we need housing in these places.
Right.
And then we'll sell them and don't over lever, so you can get permanent financing on fairly easily. And then you sell them when the time is right to sell. And you and I both know that happens every cycle. There's a moment in time for a year or two that everybody wants to own, multifamily apartment buildings, and they start competing and all that type. That's when you sell, right? And you can't ever say when that is, but you build, you stabilize, you hold with low leverage, keep building and do those few deals a year, and then sell them at the right time.
I think that's a great way to end it, because I think at the end of the day, having the ability to sell when you want to sell is the key to this business.
Yes.
Being forced to sell when you don't want to sell, that's the toughest part. So, Dennis, on behalf of myself and the rest of the team here at Way, we can't thank you enough for joining us. And to the audience, we'll make sure that you get a chance to find a way to connect with Dennis. Dennis, thank you so much.
Yeah, thanks, Malcolm. Always happy to help out, and good to see you as always.
All right, appreciate it, bud. Take care.
Okay, bye. Yeah.
Thanks for taking the time to tune into our latest show. As always, you can find us through our YouTube channel at youtube.com/@wayontheedge or at our website at www.waycapital.com. Until next time, keep working on the edge.